There is a moment that every central banker dreads. The moment when the two primary objectives of monetary policy point in exactly opposite directions. When fighting inflation requires causing unemployment, and supporting employment requires tolerating inflation. History has a name for this moment. It is called the impossible dilemma. And history has a pattern for what happens next. The central bank that chooses correctly tends to be remembered. The central bank that chooses incorrectly tends to be dismantled. The Federal Reserve faces this dilemma today. This is the history of what happened every time before. The first modern central bank crisis, September 1931. The Bank of England faced a run on sterling. Britain had returned to the gold standard in 1925 at an overvalued rate, Winston Churchill's decision. By 1931, gold was flowing out of the Bank of England as investors converted sterling to gold. The impossible dilemma: raise rates to defend sterling, which would deepen an already severe recession, or let sterling fall, which would break the gold standard and destroy Britain's financial credibility. The Bank of England chose to defend the pound. It raised rates. It failed anyway. Britain was forced off the gold standard on September 21, 1931, 2 days after raising rates to defend it. The lesson recorded in every subsequent central banking textbook: a central bank cannot defend a currency it does not have the reserves to defend. And a dilemma that cannot be solved by the available tools is not a policy problem, it is a structural problem. The Federal Reserve made the opposite error. Between 1929 and 1933, the Fed allowed the money supply to contract by 1/3. It was not raising rates to fight inflation, it was allowing deflation to deepen a depression. Why? The Fed was following the real bills doctrine, only lending against productive economic activity. As the economy contracted, eligible collateral collapsed. The money supply contracted with it. Milton Friedman later called this the Great Contraction. He argued it was the primary cause of the Great Depression's severity. The Fed did not cut rates aggressively. It did not expand the money supply. It allowed 3 waves of bank failures to propagate unchecked. 9,000 banks failed between 1930 and 1933. The Fed's impossible dilemma in 1930: stimulate and risk moral hazard, or do nothing and allow the financial system to purge. It chose to do nothing. The cost? A decade of depression. Paul Volcker faced the most clearly defined impossible dilemma in Fed history. October 1979. Inflation 13%. Unemployment 6%. The mandate: control both. The available tool: interest rates. Volcker's analysis was precise. He believed inflation expectations had become unanchored. Every worker expected higher wages to offset inflation. Every company raised prices to offset higher wages. The spiral was self-sustaining. To break it, you had to break the expectation. To break the expectation, you had to cause enough economic pain that people stopped assuming inflation was permanent. The rate? 20%. The result? 2 recessions, 10.8% unemployment, death threats, and farmer protests. And then it worked. Inflation fell from 13% to 3%. The economy recovered in 1983 and grew for the remainder of the decade. Volcker chose inflation over employment. He was right, and the cost was enormous. The lesson? The correct choice in an impossible dilemma often looks wrong for 2 to 3 years before it looks right for a decade. Draghi, European Central Bank, July 26, 2012. 3 words that ended the European sovereign debt crisis. Quote, "Whatever it takes." The impossible dilemma in Europe:
13 countries sharing a currency but not a fiscal policy. Italy and Spain were borrowing at 7%. Germany was borrowing at 1.4%. The spread reflected market doubt about whether the Eurozone would survive. The ECB's impossible dilemma: intervene aggressively and risk German inflation, or hold back and allow the Eurozone to fracture. Draghi chose intervention. He announced the Outright Monetary Transactions Program, unlimited purchases of sovereign bonds. The program was never used. The announcement alone was sufficient. Italian and Spanish yields fell immediately. The crisis ended. The lesson? Sometimes the impossible dilemma is resolved not by the action, but by the credible commitment to act. The central bank's power is not just its balance sheet. It is the market's belief in its willingness to use it. March 18, 2026. The Federal Reserve held rates at 3.5 to 3.75%. The updated projections: GDP forecast cut to 1.7%. Inflation forecast raised to 2.8%. The dot plot: one projected cut in 2026, but two members now project 0 cuts. Powell's characterization: elevated uncertainty. Here is what the historical record tells us about this moment. The Bank of England in 1931 had the wrong tool for the wrong problem. The Fed in 1930 had the right tools and chose not to use them. Volcker had the right tools, used them correctly, and paid an enormous price. Draghi had the right tools and resolved the dilemma with a sentence. The 2026 Fed has tools that are calibrated for normal conditions. The conditions are not normal. GDP 0.7% in Q4 2025. Oil $100. Inflation above target and rising. An oil shock that monetary policy cannot address directly. The impossible dilemma of 2026 is structural, not cyclical. Interest rates don't drill oil wells. Interest rates don't reopen the Strait of Hormuz. The Fed can manage the financial system's response to an oil shock. It cannot solve the oil shock itself. Every central bank that faced an impossible dilemma faced a version of the same question. Not what is the right policy, but what is the policy that the available tools can actually execute. The Bank of England chose correctly and failed anyway. The Fed in 1930 chose incorrectly. Volcker chose correctly at an enormous price. Draghi chose correctly with a sentence. The pattern across 95 years of central banking: the impossible dilemma is not resolved by the right answer. It is resolved by the right question. If the Fed's tools cannot address the source of the dilemma, what would the right question be? The shadow ledger: financial history that explains the present. If this changed how you see the financial system, there are 15 more hidden patterns exactly like this. Subscribe before the next one disappears from your feed.